All right, so we've worked our way through assets, liabilities, and revenue. And now we get to what I think is the moment of truth for the CMA exam, income measurement. Look, this isn't just about crunching numbers to get to a final bottom line. It's about really understanding the quality of a company's earnings and being able to tell the full story of its performance. So let's dive right in.
It's so easy to just skip to the bottom of the income statement and see net income, but that number can be really misleading. As a future CMA, you have to be able to look at that number and ask, okay, where did this profit actually come from? Did it come from their main business, selling their products day in and day out? Or did it come from a one-time event, like selling off a huge factory? One of those is sustainable. The other, well, it's just a one-hit wonder. And that difference is everything.
So how do we see that difference? This is why the CMA exam loves what's called the multi-step income statement. And for a really good reason. It has more predictive value. What does that mean? It means instead of just giving you one final number, it breaks profitability down into these key stages. It gives us a much, much clearer roadmap of where the money is actually coming from. And the first stop on that roadmap is gross profit. I want you to think of this as your first level check on the business. It answers a really basic but super important question. Did we price our product correctly? After you account for what it literally costs to make the thing you sold, how much money is left over? This is the foundation for everything else. Next, we get to operating income. And honestly, this might be one of the most important numbers on the entire statement. You take that gross profit, and then you subtract all the costs of actually running the business. Things like marketing, salaries, rent. What you're left with is the profit from the company's main day-to-day operations. This number shows you the true health of the core business without any distractions. What's so crucial to see here is how these two levels tell a story. Gross profit tells you about your product's profitability, but operating income tells you about your core business's profitability. You could have a company with amazing gross profit. Maybe they make a really high-margin product, but if their operating income is terrible, it means they're spending way too much money just to keep the lights on. And that's the kind of insight that has real predictive power. Okay, now we get to a really critical concept in accounting. I want you to imagine there's a line drawn right across the income statement. It's an invisible line, but it's so important. Because this line separates your normal, predictable, recurring income from the unusual, one-off stuff that's not expected to happen again. And here it is. We call this the line. And officially, it's your income from continuing operations. The way to think about it is this. Everything above this line is your normal business. Everything below it is a special event. And these special items have two rules you absolutely have to remember for the exam. They are reported separately, and they are always, always shown net of their tax effect. So what's a classic example of a below-the-line item? A discontinued operation. Now, we're not talking about selling one old delivery truck here. This is a major strategic shift. We're talking about selling off an entire product division or shutting down all of your operations in Europe. We pull these results out of the main section and report them separately, net of tax, of course, because they have zero predictive value for what the company is going to earn next year. Now for a topic that, I'm not gonna lie, trips up a lot of students. It's called Other Comprehensive Income, or OCI. The best way to think about this is like a special holding area. It's for certain gains and losses that are so volatile, we just don't want them messing with our net income every single quarter. It's kind of like ghost income. It's real, it affects the company's value, but we keep it separate from the main show. So how do you remember what goes into this weird holding area? Simple. You're going to remember the acronym POOFY. P is for pension adjustments, U is for unrealized gains and losses on certain investments, F is for foreign currency items, and I is for instrument-specific credit risk. Seriously, just burn POOFY into your brain. You will see these on the exam. So, if net income isn't the whole story, then what is? Well, it's this: comprehensive income. This is the true all-encompassing measure of performance. You just take your regular net income, and then you add in that ghostly other comprehensive income. What you get is the full picture of the change in a company's value from all of its business activities during the period. Okay, before we wrap this up with a massive exam tip, I want to pull back for just a second. I need to remind you of the one core accounting principle that everything we just talked about is built on. You absolutely must have this down cold. It's non-negotiable. Remember, all of the financial reporting we do, everything on the CMA exam, it's all built on the accrual basis. This is totally different from the cash basis, which is kind of like just looking at your checkbook, money in, money out.
Accrual accounting gives us a way more accurate picture of performance because we recognize economic events when they happen, not just when the cash finally moves. And the heart of accrual accounting is the matching principle. It's so simple but so powerful. We recognize revenue when we've earned it, and then we match all the expenses that we use to generate that revenue in the very same period. That's it. This one little rule is the reason we have things like depreciation and accounts receivable. It is the absolute bedrock of proper income measurement. Okay, let's land the plane with a direct, actionable strategy that's going to help you score points. This is my success strategy for you. The single most common mistake I see students make on income measurement questions has to do with those discontinued operations. It's a tiny detail, but under pressure, it's so easy to miss. Look at this number. Let's say an exam question tells you the company has a pre-tax loss of $100,000 from a discontinued segment, and then it tells you the tax rate is 30%. What is the impact on the income statement? So many people will just pick 100,000, but that's wrong. That loss actually creates a tax saving of $30,000. So the actual below-the-line impact is only a $70,000 net loss. Please, I am begging you, do not forget to apply the tax rate. So there you have it. You've made it through the core of financial reporting. The key now is just practice, practice, practice. But the next time you look at a company's income statement, I want you to promise me you won't just jump to the bottom line. Ask yourself, what's the quality of this income? What's the real story these numbers are trying to tell me? When you start asking those questions, that's when you're really starting to think like a CMA. Keep putting in the work, you're going to master this.